Bitcoin goes to a million, Tether's going to go 10x AUM. They made $13 billion last year. They could buy out all the major banks in 10 years' time, which is really interesting, right? It's really hard to find the gold amongst the weed. That's when you have to really understand the fundamentals of
Meet Willy Woo, a leading on-chain analyst and pioneer in Bitcoin market intelligence. With years of experience tracking the deepest data layers of the blockchain, Willy focuses on revealing the fundamental health and true investor behavior within crypto markets, and sharing these insights daily with his 1.2 million Twitter followers.
The biggest opportunity right now is not really DeFi, it's really the merger of this $900 trillion market called TradFi into a $2 trillion market called Bitcoin. And if you can make the two together, you're going to make a lot of money.
I need to ask you the most important question that we currently have. When are we going to see alt season?
You know, in my opinion,
I'd like to start this show with a slight poem, which I got from your Twitter account, which is, it's a little old though, but it's funny. Dear Mr. Bitcoin, you have 2 days to rally or you're going to print a bearish divergence on weekly charts, and then we'll be bored for weeks and weeks. We are not bored on macro, but we are bored on the price action of Bitcoin. What's recently happening in terms of Bitcoin's price action?
okay. A lot of my work is around the fundamental forces moving Bitcoin, and that is really we're measuring what the longer or medium term investors are doing with their money, and we can capture that with how the coins are moving in and out of exchanges and so forth. And we can even measure the capital flowing into the Bitcoin network per day. So, like, there's a lot of people saying, oh, look, ETFs, we captured hundreds of millions today, or MicroStrategy's buying, but that doesn't really capture the whole system. So, a lot of what I do is put a box around the whole system, say how much capital is actually coming in, is it rising, is it falling, and so forth. And presently, actually, for the last 30 days, Bitcoin's capital flows are very flat. It's $1.2 billion coming into this network per day, but that doesn't really matter. What matters is it increasing or is it decreasing? And I liken to that to like, the capital flows coming into the network is like a wind tunnel blowing up. You've seen all those wind tunnels that, you can practice skydiving, and you got the skydiver coming down, and riding this. So the updraft of capital flowing in is lifting it. And if the capital flows start to reduce from $1.2 billion a day to $500 million a day, that's a bearish action, and it's going to come down because the price is actually pushed up by that buying pressure. And so right now we're flat, right? In a flat environment, um, what is price pushed around by? And that is tactical trading. Like, so right now, the trades are dominant. Open interest was very, very high. What we saw was a massive amount of open interest open up, meaning a lot of derivative bets, casino bets, paper Bitcoin going, I'm going long, I'll match you with going short, and so forth. And so that became very dominant. And right now we're going through this phase of liquidating different positions. So you'll see that we're sweeping up and liquidating up to 108. There's supposed to be a gap, but I saw more shorts come in, so it might liquidate up to 113 even now. And then everyone's going to be bullish, but actually there's no new increases of fundamental capital investors coming in. So that's not really a good setup for an all-time high. And most likely we will reject and then come back down and liquidate the longs, right? And so we're in this sort of tactical position until we flush out so much of the DGN bets, and then what we're looking for is another upswing in the fundamental flows into this network. So yeah, that describes the environment we've been in this month. I think we may have another month before all of this resets and we're ready to sort of lay the groundwork for another upswing with backed by fundamentals.
It's interesting that we are kind of stuck at this barrier of 100k. Let's say 100k. It's like swimming around. We have been there in January. Why is
Mhm.
this level so hard to break? It seems like, is it just people are taking profits, and people, other buyers, find it very expensive to jump into Bitcoin. That's bringing this consolidation period. Or why is this again after January of 2025 the level that we saw on?
Uh, Look, in trading, of course, we know there's psychological resistances. I don't actually think this is the case because I'm measuring the actual capital flows. The flows into this network are very orderly this bull cycle, unlike any we've seen before. It's probably because you need, a move of multiple billions of dollars per day to move the needle. And so a lot of the flows are determined by institutional capital. And so we got this orderly flow, and then you've got this kind of overlay of how the market moves. When we break all-time high, it moves all the way up. There's a lot of short positions. We liquidate. It does sort of step change up very quickly. You go to 110 really quickly, but then we've got to wait for the capital flows to reach that kind of support while we kind of overshoot when we liquidate all these guys. So it's just, if you zoom out, it's just this orderly flow of price getting over exuberant because we liquidate a whole bunch of people. So their short positions turn into market buys and we go way too high. And then it takes 3 to 6 months
Mhm.
to figure it out, hit that sort of support level. And so the prices not really a good indicator of the fundamentals. The fundamentals are coming in very orderly, and it's just this crazy little thing that shoots up and down. There's all these trader games going on around it. And yeah, if you look at last year, we consolidated around the $70,000 band for most of the year before we shot up again, right? And so we're doing another one of those. Um, it's just the way the market is currently. It's deliberate, slow moves. And it may seem slow, particularly in the old days of Bitcoin, say 2013, 2017, because it was a tiny little network back then and it was retail and the thing would move very, very quickly. But this is a multi-trillion dollar ocean now, soon to be, much, much bigger. But it'll take time. I say it'll take maybe 20 years before we get to any kind of equilibrium. Once the capital flows from TradFi have come into Bitcoin, and it's going to slosh around capital flows out and in and out because of general cyclical dynamics. But right now, Bitcoin's receiving capital because it's so small, only $2 trillion. A decent macro asset should be 20, 100 trillion, 250 trillion. So capital's flowing in almost every day. In the bear markets, not much flows out, and then more flows in the bull market. Um, and back in the day, if you bought $1 million of Bitcoin, the price would go the next day, right? But it's not like that today. It's a big ocean. Well, let's call it at least it's a lake, it's not your bathtub that's splashing around. It's a lake, and we're moving into an ocean, and it takes time. Um, yeah, patience.
Well, I mean, back in the day, if you bought for 1 million, yes, markets would move. But now we have public accounts on social media going long for 1 billion on hyperliquid. Someone named James Wynn. How is that
Hmm.
impacting the price if like a random guy comes in and just opens a position for 1 billion? Because I was monitoring it during those days and it feels like it was just trying to liquidate that position at all costs and then just moving it back up again. How was that for you or your?
Yeah, generally, it depends because you can do this thing called a scare wall. The price of Bitcoin's very easy to kind of manipulate. You put up a big buy order and the market will move away from it because everyone picks up on that and they think, oh, there's demand. That happens, but there's the other thing happens, which is um, generally the price is going to go and try and liquidate these positions because it's very profitable too, right? If I have enough, like I've always said that trading in the very short term is not fundamentally based. It's based on tactical game. So you can liken it to a gridiron match where you're pushing for yards, and if your linebacker is bigger than the other, you can push the other way. So if James Wynn has got $100 million of long positioning, which is, by the way, not $100 million. He's just putting in 10 million a collateral at 10x leverage or 20x on 5 million. It's not that much capital to look big. And the other guy has 200 million and is willing to just sell into that wall. You can trigger, if there's a lot of longs, you can trigger a cascade of liquidations. And you basically pushed it by market selling and you're short the market. And as the whole thing flushes down, you buy back your position and you've won. The problem is if you've got that position, a bigger whale comes in and pushes you the other way. It's sizing matters. And if you look at the history of the price action, there's some very, very big whales. I'm very skeptical of the offshore exchanges, given that they have full order book information, and majority of them, if not all of them, have internal trading desks. The question is, do they collaborate? I don't know, but they are best suited to liquidate everyone there. And it's just, you know, it's not like Mount Gox where you're pumping the price up, but you're not good for it because these are derivative bets, and you can just farm liquidations all the way home if you've got the biggest amount of capital there.
It's such a I think it's a changing dynamic because I'm a very technical trader. I used to be a very technical trader, and it's quite clear if you look at the price action of Bitcoin lately that it's all liquidity driven. So it's just taking all the liquidations on one side and then it reverses back up as you can basically find enough liquidity to get your own position and then pump it back up.
Mhm.
In one of your recent tweets, you also mentioned that essentially there is no demand or spot demand coming into the markets, fueling the markets to the next leg. What do you think is actually required to get the spot demand going as a difference to the liquidations?
I mean, there's $1.2 billion of spot demand
That's a
per day, right? That's not nothing. What I'm saying is what pushes price up is an increase, right? Because the market's always pricing that in. And so you've got buy pressure, you've got sell pressure, and what I'm measuring is the net flows into the network. There's always guys selling, the OG that bought at $5, $100, they're consistently selling into the market, only in bull markets. It's actually a bull market indicator that these whales are selling their $5 Bitcoins at $100,000. Like, yeah, now we're gonna do it again. And so there's always this flow out when someone sells their $5 Bitcoin that they bought, 10, 20, 20, 10, 15 years ago in, and someone buys it 100,000, it's like $99,995 of inputted capital in because he's got that dollar out and he put in $5, right? So you're measuring the actual flows in, and so when we're talking about this liquidation game, right? Currently it's stagnant, right, at 1.2 billion per day for 1 month. And so there's this very sort of stable environment where the only thing that pushes things around is just liquidate all these paper bets that built up, and it really built up. So it's very, been great to like liquidate all of this, and it's coming down, it's coming down. But say you wanted to liquidate upwards and squeeze out all the shorts. And the flows into the network wasn't stagnant and they were like reducing, 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 then it's going to be really hard to liquidate those guys because you've got headwinds on moving price up because the capital flow is going down and vice versa. And then there's environments where no matter what you do, the onrush of capital coming to the network will just bulldoze any shorts, no matter what kind of games you play. And those are our full-on rip-roaring bull markets. You saw that tail end of 2020 in the last cycle and the early part of 2021, and you just saw a straight line from 20,000 up to 40,000 and no technical analysis it could break that bullish run because there was so much capital flowing in, right? It was just crazy. And so that's when you have to really understand the fundamentals of liquidity coming into the actual network, never mind the trader game. So there's two overlays of there's an investment overlay which we can measure through on-chain analysis,
Hmm.
and then there's an overlay of tactical derivative positioning and so forth. And then there's another overlay of capital rotations in and out of Bitcoin into altcoins, alt season. So, we have frameworks to look at all of this to then give you a probabilistic picture of where we're sitting. You can get in a high confidence that we're not going to break all-time highs, even though it's painting bullish candles because it's not powered by anything, and so forth. So, yeah.
Yeah, I mean, I did my research, and you have been saying, or there was a tweet on your timeline saying that the ones mostly selling physical Bitcoin at this point are the ones that basically bought anywhere around $10, and they are consistently selling their positions in bull markets, as you explained. On the
Mhm,
other hand, we also see that the amount of Bitcoin on exchanges is declining and declining and declining, which,
mhm.
if I look at it from that perspective, it's just changing hands towards probably the ETF bias, which is okay. But it's also setting up for an ultimate squeeze at some point.
Well, just certainly, I think it's mainly MicroStrategy they've been very much the main ones sucking the coins off exchanges. Um, you'd think it'd be a supply squeeze. Look, if you look at, if I was to say, look at the system, we used to only have exchanges to trade on with spot. And now there's this new thing in town called an ETF. An ETF is a pool of capital where people are trading on. And if there's more demand for the ETF, then more coins are going to flow into it. And it's going to come off the exchanges because those are the ones we're willing to buy. So you could say the ETF capital plus all the exchange capital that's reserves. Those two reserves are now the exchange. You got TradFi trading inside the ETF, and that's an exchange. And there's the partition is really where do we move that? Is more TradFi going to trade Bitcoin? Then maybe ETFs get bigger. But ultimately, that's the pool of exchange. Stored capital. Some of it's long term, just like there's plenty of people with Coinbase wallets. Well, Coinbase, Binance, OKX wallets that are stacking their coins there in a custodial manner that's sitting on the exchanges. And they're not safe, but they're long term. There's long term investors in ETFs, and there's short term traders in both, right? And so we can't just look at the exchanges sucking it off. You have to add ETFs, and then MicroStrategy is kind of a one way. It's only going in, and it's trading against the share price relative to NAV, and it's kind of a weird beast, right? But um, yeah, I mean, you could say MicroStrategy is a demand-driven thing, but we really needed to look at the whole, and so it's not necessarily a supply squeeze. Also, bear in mind that many people that have bought the ETF sold their Bitcoin to buy the ETF or sold their Bitcoin to buy MicroStrategy. So it's just rotation of the same. There's no net inflows
Hmm.
from that rotation. It's just a different wrapper over your Bitcoin holdings. Because it is useful to have a wrapper, an equity wrapper in TradFi. For example, Plan B said that he's like not holding self-custody, he's going to, brokerage accounts. Well, it's still very early in Bitcoin's arc, and if I want to borrow against my Bitcoin, the easiest thing is to custody it with your brokerage or your bank. And now it's an equity, well understood thing. They'll give you a LTV on it, and you can take a loan against it. MicroStrategy being a very old company with good balance sheet, my bank gives 60% LTV on it. whereas IBIT gets 20%, whereas Bitcoin gets zero, right? They don't even custody it properly, so very few banks will let you borrow against it. So there are advantages why people do that. Other people do it because they want to invest in their retirement accounts and so forth.
There's
So it's a
also
rotation, not yeah.
there's also the security part, right? I mean, there's also rumors that if you are a public account, you'd rather want to have a ETF than store your Bitcoin anywhere. A lot of weird stuff has been happening in Europe in terms of security and crypto
Yes.
CEOs or
Yeah.
whatever there is. There's also risk for having self custody instead of um, doing it with an
Yeah.
ETF or with an exchange. All these three things have risks involved. And I think it starts
Exactly.
to shift a little bit in the sense that also when you, as you said, if you have it in equity, you can basically get a loan or you can use it as collateral. Perhaps in the future we can have Bitcoin as collateral and get the same. And all these things concerns is probably moving people around towards different assets. I would say so.
Hmm.
Um,
Yeah, well, definitely different, wrappers on it into securities. Yeah, there's advantages in both.
anyways, the markets are moving around, which means that on-chain data becomes, I think, way more important to analyze. And it's also that's what I kind of feel when I started using on-chain data is that it's super complex. It's a lot of
Hmm.
new frames, new indicators that you need to understand, which is hard to grasp. I mean, any indicator is hard to understand, but you've been in the space for a long time, focusing on-chain data, and recently, or you've been working with a company called Swissblock, making it easier for people to understand through different documents. But what is Swissblock, and why are you partnering up with them?
Okay. Fully agreed with what you said about on-chain. There's a lot of stuff there, and it's really hard to find the gold amongst the weeds. Now, I started doing the early work in on-chain analysis in 2016. Built some of the very, very early market signals. NVT was one. There's some very early signals and work so 2016 was kind of the year we saw different on-chain signals and different ways of looking at the on-chain structure to look at the market start to develop. Now it was a company, it was actually a proprietary hedge fund in Switzerland and Swissblock, and they've been trading on-chain signals from as early as that 2016. Looking at the work that I did, others did, they built upon it. They were trading very successfully from that, and ultimately they launched Glassnode to put all that data out to the public so others could use. So they are the founders of Glassnode, and everyone knows Glassnode. No one knew Swissblock, which was the hedge fund, private money that was doing all the trades, funding Glassnode and effectively building the early research into it. So there are separate research teams now. Glassnode is very, very deep inside the on-chain data. Swissblock is very much about putting that into real world use to trade for profit. And their trade record is very good. Um, Very private also. It's a private fund. My day job is a fund of funds. We track 700 hedge fund managers across digital assets. So we got their trading P&L. I can tell you a lot of it is traded very, very badly. We try to find, we only invest in like I think around 15 out of the 700,
Hmm.
give you an idea. And so you can totally get wrecked being inside these trading firms. I can tell you Swissblock has by far got the most battle tested 9, 10 years trading through systematic. And so what And obviously, I've known them for over 5 years now, through Glassnode and the founders. So deep trust. And we came together and we went like we've done all this research, studying liquidity. Understand what Bitcoin really is and what is a digital gold. Yeah, sure, I can say it's digital gold, but what is it really in the context of global macro markets? And actually, it's kind of a liquidity. It's like the global macro canary in the coal mine liquidity, sort of alert, because it's the first thing that's sensitive to liquidity and global macro. That's some of the research that's come out, and so we kind of joined forces, brought all our models together. Because I've been, since my last, cycle, I've been full on researching liquidity as well, and um, what we felt was with this particular cycle, it's just very plain to see the whole TradFi world is running to Bitcoin. They've got no choice because Bitcoin is going to dominate global macro over the coming 10, 20 years, and everyone knows that. And so we see that there's going to be a lot of traditional finance entities. Traditionally, they have been the Bloombergs of this world, Morningstar, the research firms that are going to come in, and will come in and represent Bitcoin. And us being Bitcoin natives, um, and being in the space for you know a long time, and even in the last cycle, some of the very big global macro name brand hedge funds went to Swissblock to understand Bitcoin from a data-driven aspect. We felt that we're in a perfect place to represent this industry, to institutions natively from the ethos of Bitcoin, and we didn't want it represented by the next Bloomberg, the next Morningstar, who are traditional finance that's trying to understand it, whereas we've been trading this for 10 years. And that was really the gist of it. It was like that excited me that we could, represent this space from within the industry. I always thought when I got into this, I've got like X years, and then the TradFi guys would come in and eat our lunch. Basically, the rocket scientists would come in, and then when I saw Swissblock and what they were doing, and then mentoring the global macro hedge funds, and now watching global Swissblock get successful enough that they were like, we're ready to expand and become a global macro hedge fund. And so they're trading global macro now from the birthplace of digital assets and crypto and Bitcoin trading. And so there's something from our industry going out to the world, but we know the space, right? And so we wanted to do that, really. It was an ethos thing, obviously. It's not like, if you look at, what pays for Glassnode and what pays for all this research is really Swissblock. The revenues from it probably aren't going to make much of a dent, putting out all this research. But we want to do this for the industry as an ethos thing, and that's what brought me into it. Because my day job is running funds; it's not really, doing this sort of market analysis anymore. But I do it to keep myself on the tools. So anyway, that's the reason why we're doing it, and I can't be more thrilled to be with partners like Swissblock because of the long-term trust, long-term integrity, and just the top of the game that they play at. So
I mean, everybody knows Glassnode and all the data that
yeah.
they produce, and I've been
Mhm.
using it myself, and I quite quickly understood that I really need to dedicate my time to actually know what's in there, and that's why I stepped
Mhm.
away a little bit. But if you talk about you're a fund of funds and you allocate funds into 15 out of 700 hedge fund managers. I've got my own fund, or at least we go live in around this period.
Mhm.
The question that we usually get from people is, why would you want to go to a fund in crypto when you can easily buy your Bitcoin yourself?
Yeah, so if you're a fiat maximalist, right? Like for example, our USD fund, last year did, 20.5% gross, before we applied our fees. If you're a traditional investor, You really have to beat 7 or 8% per year because the government's gonna steal that from you basically through debasement. Debasement's 5%, GDP growth is 2 to 3%. So 7 to 8% is what you got to beat. Otherwise, the wealth pie is being shrunken from you. So if you're like that, you're a family office, you don't want to take volatility risk, then you know 15 to 20% is pretty nice. You're going to get rich. You're going to beat the S&P 500. You've got no downside volatility, and that is really that's driven by just the volatility and the liveliness of our markets. Now, if you're a Bitcoin maximalist like me, I'm not really interested in that. I might put something in there. I do put something in there. We actually built it for ourselves to weather the first bear market where we had the fund. But realistically, I want to have a fixed income from that outside of Bitcoin volatility. I learned very early that if you're all in Bitcoin and you don't have runway for 2 years, you're kind of screwed at the next flash crash. So that's just kind of peace of mind money. I don't care. And if it flash crashes, I take some of this and I can move it into the market. Um, then if you're a Bitcoin maxi, we just launched our own version of it on Bitcoin basis. So these are all market neutral trades, effectively transporting liquidity from one area to another because it's underserved here and we get it arbitrage. Um, and that happens across the portfolio maybe 10 times a second across all the managers. And so, tiny little wins, and you get 20%. And so, for example, if you put your Bitcoin in BlackRock ETF, you're losing 0.25% per year of your Bitcoin because of their management fee. If you put it into something like a Bitcoin yield fund, you might get 10% more Bitcoins per year. Currently, that will diminish over time as more and more capital flows in and sags down the market. That's been happening for, each cycle. And so it seems pretty nice to me that you're going to get 10% more Bitcoin per year versus half a quarter percent taken from you per year. You got to factor that in with the risks involved because a lot of this is trading across exchanges, obviously. And then you have to think about if a event happens like FTX, how much exposure you get. Like typically across a fund of funds platform, diversified across all these exchanges, you'd be exposed maybe 5, maybe 10%. And so you can recover out of that in under a year. And that FTX is 1 in 10 year event. So you got 10 years of yield and so forth. So it's kind of a risk reward equation. Obviously, we provide layers and layers of risk mitigation. So crazy amounts. We have real-time on-chain alerts. Um, we look at reserves across all of our counterparties, and as soon as anything looks sketchy, we get a real-time alert monitored in 2 time zones. We have a 10-minute response rate where 2 analysts are looking at it and then get the word out to our managers to get off those exchanges. So lots of this sort of stuff, right? And obviously the exchange is getting stronger. You can do tri-party now, where the coins don't even go onto the exchanges;
Mm.
they go get into a custody provider, and it gets mirrored. And so all that's coming in. The risks are dropping. The returns will drop relative to that because more TradFi is going to come in under that structure. But I think the sweet spot is actually being in one of these funds. Our USD fund is accepted by banks, and they can use that as collateral to borrow against. Our hope is to get that with the Bitcoin one. So now you can yield off your Bitcoin, borrow USD cash, and the Bitcoin yield pays the interest rate on your cash, and you get a home for free given enough time. So there's interesting things happening right now in this space because you got these two crazy worlds where the risk-free rate in TradFi is 4%, which is like losing 3% per year because your hurdle rate is 7 or 8%. And then the other world is, Bitcoin collateralized loans. You could call that 14%. or you might even call it 30% just by holding Bitcoin. So the two systems are so mismatched that interesting shit happens, you know, like MicroStrategy is one of the ones that figured out this, and now they're like sucking in from bond markets by Bitcoin, and it's just like magic. And they sell their stock to buy more Bitcoin, and the price doesn't dump crazy, and they issue bonds at zero interest. So all this sort of craziness is happening, and everyone's if you can figure it all out, there's I said in the tweet, the the biggest opportunity right now is not really DeFi, it's really the merge of this $900 trillion market called TradFi into a $2 trillion market called Bitcoin. And if you can make the two together, you're going to make a lot of money, and you're going to have big entities being built. And the first one was Tether, and they figured this and this gateway into crypto. Bitcoin was always Tether because banks never banked them, and they solved the banking rails for them. So Binance, OKX, Bybit, they trade against tethers. Binance went the first company to get to $1 billion kind of run rate in 1 year. No one saw that before. Why? Because they didn't have to solve banking rails because Tether solved it. And for that, Tether is now like, if you want to be part of crypto, you got to have access to Tether because it's the other side of the book. What are you trading? It's not US dollars, it's Tether that you're trading against. So as Bitcoin grows, Tether, the other side of the book grows. If Bitcoin goes to a million, Tether's going to go 10x AUM, and they're going to collect. They made $13 billion last year.
Yeah.
They could make 130, and they'll be bigger than the top, I think, 3 to 5 banks put together. They could buy out all the major banks in 10 years' time, which is really interesting, right? Like TradFi will be Tether, because they cracked it early. MicroStrategy's onto a good thing too. There's plenty more of these to come because not all the services are on digital asset rails and Bitcoin rails. So that's where it is. If you look at where DeFi is, that's only $5 trillion market cap in the traditional markets. It's kind of tiny, really tiny if you win all of TradFi onto DeFi rails. And so that it kind of explains the tweet a bit more. Like we're dealing with really big sums of money right now. If you can crack, if you can crack the formula and you can do crazy things, you can put things into a Bitcoin yield fund and it pays off your house in 4 years without you doing anything, and you get your Bitcoins back. The markets are so different right now, and this amount of turbulence coming in is like you get these great companies. Um,
It's it's interesting where you're going to talk about or Swissblock in a little bit, but recently there are two big new topics starting to come around. One is stablecoins, which is like there
mhm,
are all of a sudden we have hundreds of stablecoins. While if I recall 3 years ago, a stablecoin algorithmic one died down, and now we have 50 new algorithmic stablecoins, and it's all yay. And we
mhm,
have basically MicroStrategy being copied by a ton of companies building a Bitcoin treasury, which,
mhm,
if we have a physical Bitcoin world, it's phenomenal if companies are going to do that. But it's not only physical Bitcoin that's being traded. You actually need to have a lot of debt to probably buy more Bitcoin. MicroStrategy is taking a lot of debt to get more Bitcoin. And at some point, people will lose. There's always
mhm,
risk involved by building those treasuries.
mhm.
What's your view on like the expansion of all the Bitcoin treasuries and
Yeah, it kind of reminds me of the ICO bubble in 2017. And you really need to do your research. Market strategy is relatively robust. The MNAV is, targeted around 2. For sure, in the next bear market, it's going to go from 2 to below one, maybe at one. Let's see. Last time it went to point 0.8, I believe. Um, so, in a bear market, it's kind of nice to short MicroStrategy. Sorry, Michael Saylor, but you're getting 2x leverage also on the downside.
Yeah.
But I would say, not all of these Bitcoin treasury companies are doing the same formula, right? Their debt structuring is very, very different. Like MicroStrategy's debt structure is very robust. Currently, they're doing 8 to 10 years out to maturity. That means that they can weather 2 to 2.5 cycles ahead before they're in danger of needing to pay back the debt without the debt holder converting to shares. So, in simple terms, Bitcoin needs to rise above double in 8 to 10 years, just given the MNAV is two. And if it rises above double in 8 to 10 years, then the debt holder will convert and you're all good. There's no need to liquidate Bitcoins, right? So that's very robust. I don't think any one of us in Bitcoin expect Bitcoin to not double in 8 to 10 years. Um, Geez, even S&P 500 might have a chance of doing that in 8 to 10 years. So it's very robust, but you really need to look at the debt structuring of each individual of these strategy playbooks. And I can tell you now, not all of them are doing the strategy playbook.
No, that's
That's
true.
robust debt, right? So they are, I wouldn't say a systemic risk. I think they're just good shorting opportunities in the bear market. Some of them are borderline crazy, in my opinion. Won't name names, but I'm only starting to do the research on. I'm going to do the research on a whole lot, but I'm a bit shocked about the debt structuring of some of these, and the risks are very high, which is actually in plain terms for us. It's like if you want to short in the bear market, don't recommend it unless you're a really sophisticated actor. Hey, there's stuff out there that's going to give you free leverage with very little downside. You're normally having to pay for leverage and your liquidation risk is going to be high, but given the debt structuring and the MNAVs and all of this involved, you're actually getting quite a safe short position here. And there are these bits in the market where you really understand the product. It's very de-risked to do leverage. Shorting a high MNAV that's using very, very dangerous debt structuring is very safe in a bear market. I have a story where one of our team members did 100x long in the bottom of the COVID crash. Um, and if you worked it out, you think if it goes 1% against you, you're liquidated. No, if you understand the perpetual swap contract, um, it actually had to drop, I think, 500 $1,000 before you got liquidated. Because liquidation isn't the price of the perp contract, it's the price of the index. And they were so disjointed. The perp had to it had $500, it was trading at 4,000, by 3,000, and it had to drop another $300 even at 100x. So he went 100x long and killed it, right? That was very, very risk-free going long in that situation because he understood the underlying mechanism he was playing with. And I think, yeah, I see a lot of risk. I see a lot of people being shot down on Twitter when they talk about this risk, but the risks are real. If I was creating a Bitcoin treasury company, I'd be very careful about structuring the debt. Um,
But it's just
yeah.
like it's a new phenomena where
Hmm.
also when I go to golf or like friends of mine are playing golf for networking, it's all like I want to buy the company that's having a Bitcoin treasury, which is it's indeed good to have Bitcoin on your balance sheet, but you need to structure it well because if an unknown investor comes in and buy your stock, it's indeed just like buying the next altcoin. You simply just you don't know whether it's going to survive any heavy volatility. And actually, I think you talked about it on a different show, but there's a difference between paper and physical Bitcoin. We have been going on it for a little bit.
Mhm.
But if we would only have physical bitcoins, then it would be a very organic market. But by the fact that we can create synthetic bitcoins and paper bitcoins, it
Yeah.
will create those bubbles at some point. It will start like have those sort of curves where you more and more people are intrigued by this model, so there's more depth being created to buy those bitcoins, and then at some point the depth will collapse, bitcoin prices fall, etc. It's just very similar to what we originally already have in the financial markets.
Yeah, I mean, the paper is actually usually almost all cases acts to sag Bitcoin down because it's just free hitchhikers. And it's another way of saying
Hmm.
you're debasing the currency. That debasement you can measure. I think I need to double check, but it's around million Bitcoins in paper, give or take a few 100,000. It goes up and down, right? But if you look at over long term, it is actually almost a straight line up in Bitcoin denominated value. Um, it's not dominant. Spot is by far most dominant over the long term. But in simple terms, 2017, 2013, prior to 2013, you saw exponential run-ups. You saw this in altcoins, exponential run-ups. Those really nice curves, and it's like boom, and then it blows off, right? But it was you don't get that anymore. 2020 was the first cycle we had paper really at volume, and it was around the top because if you think about 2017. Okay, so I want to buy Bitcoin. I've got the FOMO. It's running up. It's 2017. It's $10,000. It's going up almost every day. So you just want to market buy. Who's going to sell you their Bitcoin? It's someone who actually has the Bitcoin. And so few people have the Bitcoin because it's such an, early stage network. So few people have Bitcoin. It's only like 0.1% of the total population have it, and those people that have it are with OGs. And they understand it. They don't want to let go of their Bitcoin, so you got to convince them. The way you convince them is a higher price. So they started dumping as it ran up from 20,000 to 10,000, 20,000 over 2 weeks, right? And they was like, all right, okay, this is crazy. I'll sell some of my Bitcoins. If you were in 2020, as it's running up, anybody with bags of fiat can sell you those Bitcoins by dumping a short position on, right? So all I need to do to sell a Bitcoin is to have lots of cash, which everyone has if you're a hedge fund. The hedge funds are sitting on hundreds of billions of dollars looking for a good trade. So 2021's top was marked by heavy amounts of open interest on derivative exchanges, massive amounts of shorts matching the long demand, and it rolled over. And in fact, you, that open interest didn't dive until the end of the bear market because if you had a short position and you held Bitcoin, you were collecting um, at around 20% annualized return over a bear market. Um, so it was pretty healthy. Um, so yeah, paper is just like water
Hmm.
on the market. It just sags it down. And our last run towards the top, around $111,000. We had a real high impulse of open interest last minute because all the bets were like, it's going to break all-time high. And that's for sure not going to happen because Bitcoin does not like the free hitchhikers. It's like heavy weight to push it against. And now we're just liquidating a whole bunch of people right now. But yeah, it's more like a wet blanket over the market.
I mean, we briefly talked about Swissblock, but I wanted to touch upon the two documents that you sent prior to the show, which is Bitcoin Factor and Altcoin Factor, which I think is very helpful for anyone diving into the markets, wanting to understand what moves the market. Would you be able to explain why these two can actually assist any retail or investor in this space?
Yeah, first off, I'll say that, Swissblock and our club, we've we've created a whole series of publications, the Bitcoin vector, the altcoin vector, and there's actually higher tiers as well, right through to the Hawkeye product, which is licensed to just a handful of global macro hedge funds. And so this array of products is really for the institutions. You can be a global macro hedge fund, you can be a family office, you could be a company within the industry that really needs good eyes on the price action, what's driving the market, or you can be a professional trader. It's not really for retail because it is quite it's the sophistication is in there, and it's not really pitched for retail, and it's not priced for retail. Um, and so the premise of this framework, we're putting together like long-term studies of liquidity flows across all of these markets, from global macro through to the Bitcoin, which is the base of the framework, which drives all the altcoin markets. And we're looking at liquidity flows from Bitcoin into alts. When is alt season happening? We can tell that from the microstructure to the macro structure of these markets. So we're measuring volatility and we're picking up on definitions. We have multiple definitions of what liquidity is. And from that, we bring it all together. So it's like I can, for example, my work, I can absolutely tell you what liquidity is in the Bitcoin lens. I see liquidity as like capital flowing into the network, and also picking up of the structure of the price action. How is that, like liquidity is the downside muted because the flow of capital, and is the price action muting downside volatility? That means that's capital coming in. Um, and so there's these various frameworks and various structures you can look at, on chain, and just sheer microstructure of the pricing. And you can do that across Bitcoin, you can do this across top 200 altcoins, you can look at it as a cohort, you can go, wow, right now Ethereum is actually quite liquid. That means buy side, and it's stronger than Bitcoin. Therefore, we theorize from this that there's liquidity flows out of Bitcoin into Ethereum, and then up, big caps are going, up, mid caps are going, low caps are going, and actually in a full-on bull market, you see Bitcoin launch, Ethereum
Mhm.
big, mid, low cap, because everyone's chasing higher risk as the whole cascade goes. And there's other times where it's oscillating between Bitcoin and Ethereum, and might go mid cap and then fire off down, and it's just random noise, right? But you can pick that up and you can know what's happening between the flows going between all of these things. Is global macro pushing into Bitcoin? Is Bitcoin pushing out to altcoins and so forth? And then, the altcoin vector is looking very much into what's happening within the altcoin space and going, what's like, these are the coins that it seem to be what's really going forward right now. It even picks up some of the picks and expectations and so forth. So altcoins connects to Bitcoin. If you look at the whole lot, you get a broader view, but the centerpiece is the Bitcoin part, because that's driving the market. And in my view, and Swissblock too, it's actually quite a center point in picking up global liquidity, because it's so sensitive to the liquidity of the macro picture, outside of Bitcoin.
I need to ask you the most important question that we currently have in the space, which is the Bitcoin price, well, correlation with the M2 supply, is that valid, or is it a new meme that we try to grasp upon to get prices going? As we have that mimic where we have the M2 supply forward at 12 weeks and then Bitcoin following
Hmm.
through.
Raoul Pal, I think, posted that one.
Yeah,
Yeah,
it's
I
all
think
over
it's
social
very
media now.
true. It's very true. I've been saying this a while that, what powers Bitcoin price historically has been, um, like two sort of by demand and supplies, right? You've got internally, we always had a 4 year halvening, which was a supply shock. The supply just halves every 4 year, so the demand readjusts, and you get a impulse to push price up. And then also you get a lot of money printing, a lot of money in the system. More of that comes into Bitcoin. Just so happens those two impulses are aligned on 4 year cycles. If you look at global liquidity, it is actually on a 4 year cycle, and it synchronizes, and it's been very powerful. Bitcoin's halvening is now dropped to half the inflation rate of gold, and every other halvening halves again. So it's paling in comparison to the buy demand on by the institutions. So now really we're looking at global liquidity, which is effectively money printing. And if there's a lot of money in the system, there's going to be, like MicroStrategy sucking out of the bond markets.
Hmm.
There's going to be more of that. So absolutely, I think it is true. The global macro is a relatively complex beast. I wouldn't say that's the only thing, but certainly I believe it is fundamentally true.
I mean, we have a Bitcoin being at around 100K, while the rates are far higher than what we had in 2021. I think the climate is now like 4.5% in terms of interest
Hmm.
rates, while back in
Hmm.
2021 we were basically on zero and Bitcoin already reached 70K. Which brings me
Hmm.
to essentially the outlook where we can see that the Bitcoin network effect, hash rate are all going up and printing new highs. And there's the constant debate of whether we still have the 4 year cycle being applicable or whether we're going to have longer cycles where Bitcoin just keeps on expanding and have midterm bear markets instead of those rough 80% corrections.
Mm.
What's your outlook
Yeah,
for Bitcoin?
I think we're still on a 4 year cycle, but they're less exaggerated, because global liquidity is kind of 4 years ish. So now the halvening is kind of out, but the global macro is 4 years, a little bit less precise.
Hmm.
Um, and so I expect another bear market. I don't think it's going to be bad as like 85% drawdown of the last one, just because there wasn't so much crap and toxicity in the system. Um, but there's still a lot of crap in the system. We talked about Bitcoin Treasury companies. There's weakness there. I don't think it's like, if MicroStrategy blew up, sure, that could pretty that'd be pretty bad. I don't think that's going to blow up. But some of the smaller ones might. And so, and then also we've got so much institutional demand coming in and sovereign demand. So I think that'll buffer it. And so maybe Bitcoiners will shrug it off. So that's not a cycle. Haha, that's a um, you know, it's a mini cycle, and and so it becomes more of a sort of random walk. Or like if you look at the S&P 500 and you zoom out from it, it's actually just a straight line up with chops. And the big bear markets, it might be 30%, but it looks huge, but actually it's not that bad. So maybe it becomes more of that. I kind of feel like it's debatable. With this next bear market, we'll get a pullback and it'll look like a 4 year thing. The one after that might be a little bit better, like harder to find like a traditional, blood on the streets bear market.
Well, I hope at least that it's becoming a little bit more relaxed, as the previous bear markets have been quite rough if you're directionally into the markets. And in
Yeah.
the latest altcoin factor, it's um, it's called market phase Ethereum. So
Hmm.
the question I keep getting is, when are we going to see alt season?
Oh, you bear in mind I do the Bitcoin vector,
Yeah, that's
but
what.
that is actually it's kind of the canary in the coal mine on where we are in the cycle. That it is actually Ethereum, because almost we certainly in Bitcoin, okay, Bitcoin has not done its bull run yet. If you look at historical patterns, you kind of wind up and you really go for it, and the capital in is not really going for it. And maybe we don't get it because this is like institutions and they don't FOMO in, right? But when we look at Ethereum, that's looking strong, and usually that is a sign of strength in the market. No one buys Ethereum, no one believes there's strength in the market. So we are picking up strength there. That's picking up, that's therefore meaning there's probably flows out of Bitcoin into Ethereum. And Ethereum that makes another leg up. Um, we that's more of a signature of we're really into a proper bull phase. If that's supported by Bitcoin going up and capital is really flowing in. We are We've entered the late phase of a bull market. Early phases, we have very strong liquidity. Um, that liquidity is starting to dry up, but that's also when you see crazy moves upwards. So we are expecting a run, like another run up. Our my risk model, which is looking at drops in liquidity. Generally, as you run into the tail end, maybe 3, even 6 months before the top, you see that risk climbing. It's like early warning signal. We're late phase. We are in late phase. Um, this is in 2017. That's kind of like Bitcoin at 5,000 before it ran to 20,000. It's also last cycle in the 2021. It sort of kicked in, I believe, once we hit $40,000 and it ran up to 60. And then it screamed risk on until it dropped, and then it went up again to 70, and then it blew out. And it was high risk all the way down to 16,000 before it dropped up to low risk again. So, it's like it's kind of the most lucrative time, and it's also playing chicken with freight train. Yeah, if you want to time the top. But I would say internally within Swissblock, within the macro signals, as Henrik would say, he's the global macro economist inside Swissblock, is that recession signal is fired. The Titanic's gonna hit the iceberg. In fact, it has hit the iceberg. It's a big ship. It's a super tanker. Nothing moves quickly. Um, the ship's gonna sink, but it's not sinking yet. It's still moving forward, and the timing signature hasn't fired yet. So certainly, global macro sees strength in equities, strength in the market still. Probably another up leg. Bitcoin will probably fire. Altcoins will fire. Ethereum will fire. We'll get that rotation, and then we're in for a bear market afterwards. So it's imminent. Timing wise, well, we've got to wait for the timing signals to fire.
Well, at least there is hope for anyone that is not only in Bitcoin but also in altcoins. Um, I think
Yeah.
I think this was very helpful. Thank you very much. It was an
Mhm.
enjoyable conversation for you late night over there.
Yeah. Yeah.
Um, for people interested into on-chain analysis, where can they find more information?
I would say Glassnode has been a leader in the space. You can read their blog, you can go sign up for a free account, look at all the charts. There's a workbench in there. You can play with many things. I would say a lot of the on-chain stuff, you can see what's really happening. It provides more narrative than market signaling. You've got to really dig in deep and understand the stuff that really works. And only a very small subset is really good for trading. Some of it will tell you where we roughly are in the cycle, that sort of thing, or the whales are buying. It's just narrative. So read the blogs. It's just enlightening to really get X-ray vision on what investors are doing. Glassnode, go to there. Glassnode on X or the website .com or glassnode.com. Yeah, so that would be my pick for the on-chain stuff.
All right. Well, I've been following you for a long time, and I love the content
Mhm.
that you produce and the journey that you've been on. Would love to have you again on the show at some point. Thank you very much for being here and sharing your knowledge with us. And I'm sure all the documents and all the information can be found in the description beneath. So thank you very much for being part of the show.
Thank you, Mikhail. One thing I would say is we are currently leaking free alpha on the Bitcoin Vector handle on X, just to demonstrate the framework because it's a standardized framework to look at all of the Bitcoin market extending into altcoins through the altcoin vector. So there's Bitcoin Vector handle, altcoin vector handle, and currently we're just sending out alpha right now to demonstrate the framework. So please visit that. Thank you, Mikhail, for having me on. It's been really enjoyable to talk about markets. Been a while.
Well,
So
hopefully it's
thanks.
going to be a better market in the, or at least a way higher market that there's going to be enough to discuss about to discuss. Um, all the links will be in the description: Bitcoin Vector, Altcoin Vector, your socials, Glassnode. Once again, thank you very much for being here, and on to the next one.
Okay, thanks, Mikhail. Great to be here.